2024 will bring about multiple transitions. We expect global growth to slow going into 2024. The risk of a recession is higher over the next 6 to 12 months as the lagged cumulative effects of policy tightening starts to kick in. However, any recession is likely to be concentrated in the developed markets. Most of the emerging markets economies should continue to see growth in the new year. China in 2024 will be rebalancing its economy. The Chinese government's issuance of additional special central government bonds in the fourth quarter of 2023 raises the year's fiscal deficit from 3% to 3.8% of GDP and signals policymakers' intentions to stabilize growth in 2024. The government is likely to set 2024's GDP growth target at around 4.5% to 5%. It is, however, worth noting that China's move to rebalance its growth model from an investment-led to a consumption-based is taking place at a faster pace. In the first 3 quarters of 2023, consumption contributed 83.2% to the headline GDP growth compared to 58.6% in 2019. Inflation should continue to trend downwards in 2024, barring a commodity price shock. Global central banks are likely to be all at or close to the end of their rate hiking cycle as inflationary pressures ease, although they will be wary of a declaring rate over price rise too quickly. A pivot to rate cuts would be some months away. Nevertheless, a broad and sustained decline in inflation could usher in the turning point for growth equities. According to the Asian Development Bank, Asia is projected to grow 4.8% in 2024, marginally above the 4.7% expected in 2023. A slower China and recessions in the developed markets are likely to weigh in on export-dependent economies within Asia, while countries with large domestic consumption may be more resilient. ASEAN, as well as India and Vietnam, should continue to benefit from the ongoing global supply chain diversification. We are constructive on Asia's ex-Japan equities as the global slowdown is concentrated in the developed economies. More supportive policies by the Chinese government are helping to stabilize the Chinese economy, which is positive for the region. Asian equities also offer better value, with a forward price-to-earnings ratio at 11.7% times compared to 18.4 times in the US. Asia ex-Japan equities have lagged the US market in 2023. The region is expected to perform better on the back of attractive valuations and a more favorable economic fundamentals in 2024. As global growth slows, investors and businesses are renewing their focus on Asia for opportunities and risk diversification. The region's dynamism will provide investors with a differential alpha opportunities that are unparalleled elsewhere. A structural realignment of global supply chain away from China and towards other markets is taking place. The beneficiaries of this move are spread across Latin America, EMEA, ASEAN, and India. These countries possess cheap labor, have decent manufacturing base, and are producers of important commodities. ASEAN's growing share of global foreign direct investments, FDI, suggests that countries in the region are also benefiting from the supply chain shifts. Indonesia's abundant nickel reserves and Thailand's strong auto supply chain network makes it ideal destination for the electric vehicle supply chain. Malaysia has an edge in advanced packaging and testing, while Singapore is a wafer fabrication hub. India is yet another beneficiary of the supply chain reallocation, given that its labor cost is almost 1/6 that of China. The Indian manufacturing sector is already seeing robust growth and increasing FDI. Over the long term, continued reforms and the revival of private capital expenditure will be a key in sustaining India's growth. Despite the challenges, China is unlikely to lose its manufacturing edge. Decoupling from China will be a daunting task for multinational companies, given the country's excellent infrastructure and connectivity and extensive network of reliable suppliers. Besides, China is also moving up the manufacturing value chain, facilitated by huge investments in technology, big data, robotics, and artificial intelligence. Overall, there are structural opportunities in sectors that will gain from policy support and the consumption tilt, such as advanced manufacturing, healthcare, and consumer. Technological innovation over the years have triggered new waves of globalization. With the latest artificial intelligence will reshape the global landscape. Current buzz is over generative artificial intelligence, AI, and how it will be a next game changer for globalization. Generative AI technologies have potential to transform or disrupt many industries, which have profound implications for productivity, growth, and profitability. Advancements in AI are very much dependent on high-end semiconductor chips, which have the power to process and analyze data. In Asia, the clear beneficiaries are Taiwan and Korea. Taiwan has the full industrial supply chain to support current and future AI industrial trends. Taiwanese companies that manufacture key components such as thermal, power, printed circuit boards can also benefit by providing a complete component supply chain. Korean fabs that are developing the next generation high bandwidth memory chips will also benefit from the widespread adoption of AI. Other ASEAN companies within semiconductor supply chain, such as advanced packaging and testing players in Malaysia, should also benefit. Generative AI is expected to stimulate the development of cloud computing and edge computing and reshape industries outside of tech. These include transport, driverless cars, and healthcare, virtual doctors, education, personalized learning, and retail, inventory management. These new application areas will create additional demand for memory, semiconductors. Asian gaming companies, electric vehicles manufacturers, e-commerce players, and cloud providers are embracing generative AI to enhance their offerings and improve their competitive edge. In 2024, the global economy and investing landscape will experience long-term structural transitions. We believe investors will need to be nimble in their views and positioning, and at the same time seize the opportunities arising from the various transitions. We hope our insights may provide interest in investing in Asia.